Hi, welcome back to the channel. In this video, we're going to be discussing the topic of, is property investment worth it in 2023 fourth quarter? So I get the question all the time, is it really worth buying property in the UK in 2023 when rates are absolutely crazy? It can't work, it doesn't make any sense. And there's many people on YouTube that do say the same thing. It's not worth it, don't waste your time. But it really does depend on what rates you're able to achieve with your mortgage broker and what yields you're actually able to bring in. So this is the thing. When it comes to high yielding property deals, yes, they will make perfect sense all day long, like your service accommodation or your HMOs or so on and so forth, depending on the property and so on. However, your buy-to-let scenarios are very difficult now. So it does make sense, but things have to be weighed up. So if we deal with this from the point of view of buying a property within a limited company, at that point, you will be able to offset your mortgage interest and dance around the Section 24 legislation that the government had put in place a couple of years ago. That means that you'd be able to write off your interest as a taxable expense, which you can't do if the property is in your personal name. And this is the reason why so many landlords today are flogging their properties. That is simply it. They're unable to now make these property deals work for them, and effectively they are just breaking even, or they're in negative numbers if they're not careful. And hence, properties are coming onto the market that were decent and profitable buy-to-let properties. Okay, so that's the first thing. Yes, put it in a limited company, but obviously speak to an accountant just to make sure that that is the best thing for your personal situation. The other thing is making sure that the deal actually stacks up is quite simple. If it doesn't stack, forget it. If there's not enough float in the deal, you're going to give yourself challenges. So essentially, any lender will look at a deal and say, if I'm borrowing my money at 5%, will this work at 6.4%, for example? At 7.8%, whatever it may be. They're going to add a level of stress to that deal and make sure that in worst case scenario, this deal still stacks up and is able to float through any hard times, so to speak. So that means that you need to be looking for real profitable deals. And that's not always easy to do, but I'll give you an example of one that we're going through right now and we're just about to complete on. And hopefully in later videos, we'll be able to show you some of the process of that we're going through in order to refurb and let out this property and what we actually end up doing with it at the end. So this property we acquired via modern method of auction. It was on the market for £70,000. We ended up closing the deal at 80,500 quid. Now the property itself to date is actually worth £142,000 as it stands. And we don't have to do anything to it, and that's what it'd be worth. And I know that because a property of the exact same footprint, the exact same floor area, same layout, same bedrooms, had sold for that amount a couple doors down the road. Okay, so that's how you know whether your deal is actually going to stack up. Do you have solid comps or comparables that you can compare your property deal to and make sure that, you know, it's actually going to stack up when it comes to be sold? So that's the first thing. Does it actually make sense? Is it below market value? In other words, and yes, in that case, it was well below market value. So that means I can purchase it as it is and I could sell it back the next day. Not literally, but I could sell it back and I would make a profit without doing anything to it. Okay. But what that also means is that when I do come to refinance the property, and the idea is that you ideally want to put money in, acquire the property, and then also recycle that money, with such margin already built into that purchase, I should be able to pull my money directly out, or most of it at the least, without any problems. So looking a little bit closer at the numbers, what you see is that when you actually come to rent out a property like this at those numbers, the rental yield is going to be healthy, and it's healthy because of the area that we decided to invest in. And just going into detail, the actual rental amount per month is 750 quid per calendar month, which means that once this property is actually letted out at that amount, we should be getting a rental yield of 11.18%. So with that, I know that if I'm able to get a mortgage at, on average, 6, even 7%, I know that this deal will still stack and it will make perfect sense. Luckily enough, we managed to work with a great broker, Percom Financial Services, based out of Wimbledon. This is not a sponsored video, but we thought we'd mention him because great guy, great business. In that process of getting the mortgage, we ended up securing a mortgage at a rate of 5.26%, which makes perfect sense for this deal, and we are well below our rental yield, so there's enough float in there for us to do what we need to do. So in terms of the actual purchasing costs, you may be interested in those. The actual purchasing costs are going to total, including the refurbishment, £47,775. Then that includes £16,000 of funds for doing the actual refurb, and that will be a light refurb. So what that will include is a redecoration throughout the house. It will include new architraves, new skirting boards, new carpets, a little bit to the bathroom, and a redeck in the kitchen. We'll probably just paint the existing kitchen. And that's pretty much it, basically. So it's in really good nick as it stands, or really good condition. Good nick. And we could rent it out as it is, but we want to bring it up to, you know, a more modern standard. So new bathroom, and potentially a little bit of work in the kitchen, but not too much. Okay, so in terms of the other figures that we need to consider as well, I'm just looking down because I've got the numbers in front of me. So the actual costs, running costs per month, that's also needing to be considered. So insurances, maintenance, and also the mortgage, of course. So all of those total £484, which leaves us with a net figure of £221 per month. So on a deal like this, you're talking a gross ROI of 18.84%. And this means that we should be able to get our money back with just over 5 years, let's say. Now, in terms of if we was going to sell this property on, if I was to look at that option, effectively at a similar amount of upfront investment costs, we would be talking a profit of roughly 30k, 25 to 30k, and that would leave us with in excess of 25% of ROI if we was to sell that property on. Now, with this property, interestingly enough, what we're also looking to do is maximize the potential growth or potential income from this property by adding in a third bedroom. Now, if we can do that, what that will then do is make this property not worth £142,000. It would then go up to £160,000. But of course, that will mean additional costs in terms of refurbishment, but it will drive that value right up. Now, if we do that, we're then talking, you know, 40% return on investment if we was to sell that property on. And if we was to actually rent that property out, keep it, rent it out, which is the intention anyways, the rental amount would actually go up to £850 instead of £750. So that will bring our rental yield to 12.67%, and that will net us £361 from this property purchase, which was initially at a purchase price of £80,000 and 500 quid. So is it still worth investing in 2023? The answer is, it depends. If you can get great deals like this one, then yes. If you can't, you might want to think twice. But bottom line is making sure that the numbers stack. If they stack, if they're below market value, if you're buying in the right way with a limited company, then it should, fingers crossed, make sense. Thanks for watching. See you in the next video.